Stacked imbalances. Order flow traders swear by them. 3-to-1 aggression, 3 levels in a row, and you have a wall the big players will defend. At least that is the story. Nobody ever showed the numbers, so we ran them. Every stacked imbalance zone on 81 crypto pairs across 4.5 years. 118,032 trades. This is what the data actually says. Welcome to Grail on trial. Every strategy that gets called a holy grail eventually ends up here, in front of the same judge. Data. Today's defendant is one of the most respected setups in the order flow world. Here is the pitch, and to be fair, it sounds great. A footprint chart shows you, for every price level inside a candle, how much volume hit the ask and how much hit the bid. When aggressive buyers overwhelm passive sellers 3-to-1 at a single price, that's an imbalance. When it happens on 3 or more consecutive levels, that's a stacked imbalance. The theory says a big player just left a footprint. The market should remember that price. Come back later and the same player defends the wall. You buy the retest of a buy wall. You short the retest of a sell wall. The settings are surprisingly consistent across the whole industry. 3-to-1 ratio, 3 stacked levels. Draw the zone until price touches it. This is the standard playbook taught in order flow courses, and it's built into most footprint platforms. Now here's the part that surprised us. We searched for a published backtest of this, any backtest at all. We found articles, courses, indicators for sale, and thousands of chart screenshots. 0 published numbers. One quant site even says it openly. Most order flow traders don't backtest because the data is hard to get. Fair enough. We have the data. A quick word on how we test, because this is the part most backtests get wrong. First, we froze the rules before running anything. The exact industry canon, 3-to-1, 3 levels, zone dies on first touch. We wrote the rules down with a timestamp and nothing got tweaked after the results came in. This matters because if you test 20 variations and show only the best one, you're not doing research. You're doing marketing. Second, real data. We rebuilt footprints from raw tick data on Bybit futures. 81 pairs, January 2022 through July 2026. Every trade in the test pays realistic costs, fees, and slippage included. Third, we split time into periods. Rules get built on early data, then face data they have never seen. If a strategy only works in one period, it isn't a strategy. It's a coincidence. The entry, price leaves the zone, comes back and touches the wall for the first time. Stop behind the far side of the wall. And we didn't marry a single exit. We tested a whole grid of stops and targets, tight to wide plus a time stop. The headline numbers use the industry favorite, 2-to-1. The grid gets its turn in a minute. Everything is measured in R, where 1 R is simply the amount you risked on the trade. Plus 1 R means you made what you risked. 118,032 trades. If an edge exists, it has nowhere to hide in a sample like that. The win rate came out at 20%. At 2-to-1 reward, break-even is 33%. Sit with that number for a second. Average result per trade after costs. The first 2 years, minus 0.003 R0. The validation window, minus 0.03. The most recent months, minus 0.085. There was one stretch, 2024 through early 2026, that showed a small plus, 0.04 R per trade. And this is exactly where most people would stop and shout that it works, so we looked closer. In that period, all of the profit came from shorts. Longs lost money. Then we checked the bull market window and the pattern flipped. Longs positive, shorts negative. That is not a zone edge. That is just shorting working while the market falls. You don't need footprint charts for that. We didn't stop there because a fair trial exhausts every defense. We measured how far price actually travels after each retest. It goes against the position further than it goes in favor. The excursion ratio sits below 1 everywhere. The entry point itself has no asymmetry. We tested 15 order flow features at the moment of entry, real delta from ticks, absorption, VPIN, imbalance strength. Every single one scored around zero point 0.5 at separating winners from losers. Coin flip territory. We ran the full stop and target grid. On paper, wide stops looked profitable, plus 0.23 R per trade. Then we verified that exact sell in the trading engine, and it evaporated to a flat zero. Analytics on recorded trades lie because paths and timeouts matter. We have now caught this mirage 11 times out of 11 in our lab. We even made the filter stricter. 4-to-1 imbalances only, the strong walls. The result got worse in every single period. And a machine learning model on top, trained to pick only the best retests. It looked brilliant on one period and fell apart on the validation window, overfitting in a lab coat. So our footprint chart's useless. No, that is not what this trial says. The aggression is real. The walls are real. What's not real is the simple version of the story where you mechanically buy every retest of every wall on a 15-minute chart and money comes out. The market does remember those levels. It just doesn't pay you for remembering them too. Our honest read after testing dozens of strategies on this stack: order flow edges live at time scales measured in seconds where market makers operate. By the time you're trading 15-minute bars, the information is priced in and costs eat what's left. Keep the zones on your chart if they help you read the market. As a map, they're genuinely useful. As an automatic entry signal, the numbers say no. Verdict: no edge detected. Case closed. Docket number 2026-118032. If you think your strategy would survive this court, drop it in the comments. The one that collects the most likes goes on trial next. And if you want the receipts, the full trial record with every number from this video is linked in the description. Subscribe if you want the truth about the next Grail. There's a long line of defendants.